Chapter 9 is entitled Current Liabilities. As a reminder, current liabilities are claims that other people have on our assets. Remember the very first day of Solid Footing, and we had the stuff and then the claims to stuff, and there's the owner's claims to the stuff, and then there's non-owner's claims to the stuff. Remember when Dad loaned some money to the cash bucket, and then Dad then had a claim on the cash bucket? That was a liability. So current liabilities are specifically those liabilities that are due within either a year or within the operating cycle of a business, whichever is longer. So if an operating cycle is 15 months, then obviously that's longer than the year. And so a current liability is a liability that's due within 15 months. Examples of current liabilities would be accounts payable, notes payable, short-term notes payable, wages payable, warranty liabilities, lease liabilities, taxes payable, and unearned revenues. Long-term liabilities are those liabilities that are due either over a year or over the operating cycle, whichever one of those is longer. So if the operating cycle was 15 months, then a long-term liability would be anything due over 15 months. Let's talk about some of the specifics. Let's talk about sales taxes payable. If you are operating a business where you're selling anything, you're a merchant, then you're going to have sales taxes payable. Sales taxes are required by state and local governments on anything that's sold. So Walmart, Home Depot, Target, whenever they sell things, they have to collect sales taxes in addition to the cost or the price of the good. An example that the book gives is Home Depot. And Home Depot sells a product for $6,000. The sales tax is 5%, which is $300 out of the $6,000. And so Home Depot actually collects $6,300 from, let's say, from you. If you're at Home Depot and you're purchasing stuff, Home Depot has to collect $6,300. And the way they would account for that is they would debit cash $6,300. They would credit sales $6,000. And then they would credit sales taxes payable $300. Because remember, both sides always have to equal. The debits are always going to equal the credits. And so our sales, that's a revenue account. And our sales gets a $6,000 credit. But then sales taxes payable, that's a liability. It means that someone has a claim on $300 of our assets. The state, in this case, the state would have a claim on that. So until we actually pay the state the taxes that are due, we have a current liability of sales taxes payable. Say in a few months, when we're actually able to pay off the sales taxes, that would be a debit. To sales taxes payable. Because, again, think of it like we're wiping out what we owe to the state. We no longer owe anything. It was a credit, so we're going to debit it to get rid of that. And we're going to debit it $300. And then what do you use to pay something with? What would you pay your taxes with? Cash. So you're going to credit cash, $300. So that's how you would do the journal entries for sales tax and sales tax payables. Next, we're going to talk about unearned revenue. An example of that is one that we covered in Solid Footing. I think it was maybe Lenny's Lawn Service. And at one point, they got paid in advance for several months of work. And that we talked about that as being a liability because it means that someone else other than the owners of the company has a claim on those services. Someone has a claim on that lawn mowing service. Another example of unearned revenue is ticket sales. Sports tickets, concert tickets, etc. Until the concert or the sporting event actually takes place, that money that you got is a liability because you owe someone a concert. You owe someone a game. And they kind of have a claim on that game or that concert until you do it. So an example that the book gives is a Rihanna concert. And Rihanna sells $5 million worth of advance ticket sales. So we're going to debit cash $5 million. And we're going to credit unearned ticket revenue $5 million. Okay, it's a liability account. Liability accounts are increased with credits. They're decreased with debits. Once the concert takes place, let's say one concert represents $625,000 worth of those tickets. Once the concert takes place, we can diminish or decrease that liability account, that unearned ticket revenue account, by that much, because now we have earned a portion of that unearned revenue. So let's say that one concert represents $625,000. So we will debit and I'll abbreviate this. I'm going to debit unearned ticket revenue, $625. And then we're going to credit ticket revenue. $625. So once the concert takes place, we can recognize at least a portion of that money. We've decreased the liability account and then we've increased our revenue account.